Welcome to the Wisdom Lifestyle Money Show. I'm your host, Scott Dillingham. The goal of the show is to show you how you can grow personally, financially, have a larger net worth, and leverage your largest asset to help you develop the person you want to be. I take you through all the steps I did from being nothing to being told that I was nobody and I was never going to accomplish anything, from getting kicked out of high school to owning a multi-million-dollar real estate portfolio in my own company with more than 20 employees. You'll meet our partners, you'll meet our friends, and you'll quickly discover how you can improve your life. So listen in and enjoy the show.
Episode of Wisdom Lifestyle Money Show. My name is Paul McAllister. I am going to be your host today. I have a special guest, Ryan Day from Calvert Mortgage. But first, who am I? I am a mortgage agent. I'm an investor-focused mortgage agent specifically. I'm an investor myself, investing for over 10 years. I work at LendCity Mortgages, who we do Canadian mortgages throughout every province. We also do, if you're an investor investing in a Canadian investor investing in America, we can do your investment property mortgages as well in America. So I think that's really what's unique about us. I'm really excited for today's conversation with Ryan because I use Calvert a lot and I preach it a lot because some of these products that we're going to get into are so unique. And really, I've seen and people grow with these products. Ryan, introduce yourself. Yeah, so just introduce yourself, then we'll get into kind of different things about what you guys offer.
For sure, yeah. Really appreciate you having me on, Paul. I'm really looking forward to the discussion today. I know we were talking about it before the show, but we actually have a deal closing as well, too. So super happy that you're a big fan. My name's Ryan. Been with the company for just over 3 years now. Really focus on business development. So finding new mortgage brokers, real estate investors, wholesalers, flippers primarily in Alberta and Ontario. Company's been around for over 45 years, so we have a long history managing risks, primarily supporting real estate investors in Alberta. We've been in Ontario for about 3-ish years now, and we just see so much opportunity going on in the marketplace, supporting real estate investors and primarily helping investors create more real estate stock, just because obviously we're extremely undersupplied and trying to help a solution going on in order to essentially help increase supply through our unique products, as most clients buy, renovate, and sell, or buy, renovate, and refinance. So I really focus on just building new relationships and managing current relationships with top accounts and understanding how we can serve our clients better, what we can do in order to improve our service, our value proposition. And to your point, we'd like to think we have some really amazing products in the marketplace, something really unique that I'm super pumped and super excited to get into, and just very thrilled that obviously you have firsthand experience using our products, so you could vouch for the service.
Yes. One things that stand out to you is like you've been around 45 years supporting investors, which is a pretty long time. That stood out to me. And I know you're Calgary based, but you're doing mortgages, you're doing loans in Calgary and Ontario mainly, correct? Are those the two provinces? Yes.
Yeah, you got it. Correct. So Alberta and Ontario, we're looking to go start lending in BC in about 1-ish year's time. We probably said that a year ago, but we're just trying to manage the really unique flow of capital, lending opportunities, human resources, and processes and systems. We were planning on being in BC around this time-ish. However, there's just still so much opportunity in the marketplace in Ontario because we've only been in that province for 3 years. So we're going to really look to grow and expand the Ontario base, primarily lending in major urban city centers, so populations 100,000 and above. Where we do most of our business is southwestern Ontario, specifically speaking for obviously the Ontario province, but we do some northern Ontario, Sudbury, Sault Ste. Marie. We don't do Timmins, unfortunately, just because we find it's a little bit too rural. But those major urban city centers, we love lending there. The reason being is there's just a lot of data to support real estate values. So obviously the larger the population, typically obviously more housing stock. And with more housing stock, there's more data points to understand obviously what the value is currently right now and what it could be worth as if complete if a client's looking to flip a property. But general rule of thumb is we lend in populations 10,000 and above in Ontario. There's some exclusions to that, but that's typically a general rule of thumb. And then in Alberta, most of our business is Calgary based just because the company's been around, to your point, over 45 years, primarily here in Calgary. Do a lot of lending in Edmonton and then Red Deer a little bit, and same with Lethbridge. So those are the markets we focus on, the markets we're going to be expanding to.
So for the 100,000, so you said 100,000. I know it's less than 5 units, and I know the terms you want to be less than 12 months. So if I have we have Windsor, where I'm from, located, we have an office in Windsor. But then we have small towns outside of Windsor that are like 25,000, 20,000 populations. You would still lend in those places, or because I think you said 100,000, but then you said 10,000. So
Yeah,
I just
we
got a
would still
little
lend there.
confused on. Okay, so you'd still lend there just based on the
really
data.
good
You need
comments.
data.
We
to
lend in
support.
populations. Correct. Our preference is populations 100,000 and above, or 25-kilometer radius from those city limits. But as long as there's a population 10,000 and above, and the property is directly in that city, then we will lend there.
Sounds good. So then I had a deal that just closed minutes ago, about an hour ago. So very excited for that. You have a cool I guess not product. I don't know what you call it, the flip product, basically for when you're flipping houses or flipping properties, or when you are doing the BRRRR strategy and you use Calvert, your lending for the beginning, and then you have an exit. So I know everything is tied to the exit, but I just got done actually doing one where the guy's doing a BRRRR. So he's buying it. He's going to rehab a basement, and then it'll be 2 units. He'll rent it out. Then we're going to refinance it. I think we have about a 3-month timeline to do that. I just want to talk about the flip analyzer because I know how to do that flip analyzer inside. No, I really think it's a cool kind of tool. Can you talk a little bit about your flip product and then maybe the flip analyzer, and just how do you view things from your side?
Yeah, for sure. Super pumped that obviously you've used the product and you have firsthand experience. So that's awesome. Essentially, our value proposition for what makes us really unique when it comes to our flip product is, number one, in some instances, we're able to fund the deal with as little as $20,000 down for purchase prices up to $800,000. So low money down option. And that reason how we're able to do that is because we're taking a look at the after repair value, not so much the as is value. So value proposition number one. Number two is we do not require third-party appraisals. And the reason being is that we have 4 in-house analysts currently right now who are employed by Calvert, and they do remote valuations completely for free for our clients. So they typically on average value around 4 to 5-ish properties per day. So we have a really good pulse on the market on what the HPI is doing for that specific property type in that specific geographic region. So we have really good data to support our lending decisions in order to manage and essentially mitigate risk when essentially the market's going down, in order to draw back our lending or obviously increase it if the market's going really well. So don't need an appraisal, low money down. We can fund deals in as little as 3 business days in Ontario. And how we're able to do that is, number one, we don't require a third-party appraisal. Number two, we draw up all of our own mortgage instructions for the lawyer. And this really helps the lawyer essentially act quickly when it comes to closing the transaction, because a lot of the work is already done, and it's very clear direction on essentially what our mortgage documents entail. On that note as well too, we've partnered up with a few, around 2 to 4 law firms that really specialize on quick closing fundings, and that really helps the client service as well too. If there are any very time sensitive scenarios where clients they're in a pickle, they're in a pinch, and they need to close in just a few days. Mortgages are fully open as well too. Obviously, real estate investors love this, not having any prepayment penalty. Having it fully open obviously incentivizes them to be in and out as quick as possible, and not having to worry about any of those pesky fees when it does come to exiting the mortgage early if it's with a traditional lender. Point number, I guess 4 or 5 we're on now, is we are able to also collateralize other properties completely for free using our valuator. So let's say typically real estate investors have a property or 2 at minimum. As long as they give us property photos as of today and a most recent mortgage statement, they would hand that off to you. You would hand that off to our underwriter in-house. They would pull comps, take into consideration what's recently sold using the direct comparison approach, and pull 3 to 6 comparables and essentially assign a value to what the property our appraiser believes will sell for as of today on the MLS. And we will lend up to 75% of that in second position as long as there's an A or a B lender in first position, we don't go behind other privates. And then obviously it's subject to the deal as well too, the property type and the location. And the benefit to the client for this is they're able to tap into the equity of another property that's currently sitting idle, and they're able to get in either number one, a higher loan to value on the subject property. So we would advance them, obviously the down payment, or we could advance some renovation funds, or it could be a combination of the two. So we're able to really we're able to find really creative solutions for our clients with the other assets that they currently have available. And this is all for free as well too. Like, we just need property photos. It's hassle free. Don't need to go in, schedule an appraiser in there. I'm currently working with one right now for me personally, and it's just less of a hassle as opposed to doing it the traditional route. Obviously, with alternative lending, you're going to pay a premium, but we typically find that clients of ours, there's a time and a place for alternative lending, and having a short-term mortgage is one of the needs and the requirements that obviously, as long as you're comparing apples to apples, it's very situation dependent on when you'd use us. But we'd like to think we have a really unique value proposition for low money down, no appraisal, quick turnaround time, creative solutions, and hopefully from your experience, really timely service as well too when it comes to replying to our clients.
Yeah, so I could attest to all what you've said there. A lot of things stood out. I just learned about the collateral. I didn't know about the collateral thing, and that's something I'm going to have to be coaching, because I'm a coach as well. I'm going to be coaching certain people through. I didn't even realize that. So thank you for letting me know about using collateral from existing properties. It's something that I wasn't really thinking about it when I think about that product. So you've just evolved my thinking. But some other things I wanted to...
Yeah, I find it's...
Go ahead.
I was going to say, I could even give an example, because I find examples typically help people who aren't, specifically in the mortgage industry, essentially help solidify their understanding. So if easy numbers, they had a property worth $1 million. Obviously, we go up to 75% of that, so 750,000. Say if they had a mortgage with TD for 500 grand. So in this example, you just do 750,000, subtract 500, and that's 250,000 in equity. And we essentially just view that 250 in equity as quote unquote cash that's sitting idle. Say if they were purchasing a property for $1 million, then they could use this 250 in equity as a 25% down payment, get our cheapest interest rate, which is 9.99% currently as of today in February. We would advance the full $1 million of the subject property that we're going to be going on title. We'll be in second position on the property we're using as collateral. So it's one mortgage registered against two properties, 6-month term, fully open, and they're getting it at 100% loan to value on the as-is value. And the reason why we're able to do that is because we're taking a look at the global loan to value, not so much just obviously the as-is value of the subject property. Say if they wanted funds for renovations and they wanted to put 10% down, so $100,000 on the $1 million, and then they still have $150,000 left over that we could advance them above the purchase price if they wanted funds for renovations, closing costs, operating costs, whatever the case may be, in order to best service that client, to give them the access to the capital that they're looking for in order to scale. Keep in mind, all of this obviously is subject to due diligence. It really depends on the client and the deal, but that's just a very rough scenario in order to solidify the understanding of the applicable scenario that this could be implemented.
Yeah, I think it's clear. For me, it's 100% clear. For the listeners, like kind of what I do here and what I can give you an example what I did this week. So I got a client that come to me a week ago. He said, all right, I have this property. I want to buy it. It was under contract. He's like, I want to BRRRR it. And I said, okay. So I went through with him and built the flip analyzer saying, what is the scope? You have to get clear on the scope. And what I've noticed is Calvert don't just want you to say, oh, I'm doing a kitchen. It's going to cost me this. No, they need to understand what type of cabinets are you putting in, what type of some more details, because they're going to be looking at the ARV. They need to calculate the ARV. If you're putting in garbage cabinets or whatever, that's going to affect your ARV compared to you're putting custom cabinets or you're putting granite countertops compared to linoleum. Getting very clear with the scope is something that I start with the client. I actually do a PowerPoint presentation where we take the listing photos, we just put them in a presentation. We say, okay, in each picture, what are you going to be doing? And get clear on that. And then so that's just to help them understand, verbalize what they want to do. And then it's the next step is, okay, you know your scope. Now go get a quote from a reputable contractor that that who's actually going to execute the work. And so to me, before we even go to Calvert, we've done this presentation, we've figured out the scope, they've got their quote, and then we've filled in this flip analyzer that just basically walks you through what are your costs going to be up front, what type of fees are involved, maybe related to financing, what type of operation costs, meaning like the bills that you're going to need. So they want to know everything. And then at the end of the day, they actually have it so, like, to me, this flip analyzer is so good because it tells you what is going to be your return on your investment. Basically, what did you buy it for? What did you rent it for? What is the ARV? What did you buy it for? What do you think it's going to be worth when you're done the renovations? How much did you spend on renovations? And it's just so clear. This sheet to me is, I'm an engineering background and I love these little sheets. So what I'm actually doing with clients is working them through, one, building the scope out, getting the documents that you're going to need for due diligence, because I know you're going to need them. And then furthermore, what is the exit strategy? So if you go to Calvert, from my experiences, if you say, oh, here's what we're going to do, and here's what and then we're going to go and we're going to get refinanced. And to me, the more detail you can be for what you're doing from a lending standpoint, if it's not just a sale, if it's a refi, the better, right? Like for this specific case, he came to me last week. We got him all that stuff. Monday, we got it to Calvert. Today we close, which is Friday. So we have Monday to Friday, we've closed. And with the same thing, you have your lawyers. I have a lawyer that will close a deal in a day. That's why I use him, because he can close in a day. Not many lawyers will close in a day, but he will, especially if he knows if there's pressure on him, especially because we do so much kind of business together. Like, we know how each other work. And even he does his in-house title searches or anything like that. So he has unique things that make me want to use him more and more. He can even virtually close. Those are things that, like, and it's not just like a DocuSign thing. He gets you on camera, you can see his screen. So there's things like that helped us get from Monday to Friday. But Calvert, the amount of time it took for us to give them the package, to review the package, to ask us some questions, to provide maybe more documents, to get to close is 5 days. We can do it in 3 days, really. So that's everything you've said. This was a live example that I've seen happen. You can supplement if I didn't say anything as clear as I think you see it, but this was my example that just happened this week. That's what I wanted to share.
Yeah, you nailed it on the head. And to your point, a few things I'd like to touch on is we lend to first-time flippers all the time. When they are first-time flippers, we're going to share our expertise, even if they're experienced flippers, but share our expertise, our knowledge, our resources. Everything that we see going wrong or potentially going wrong with the deal, we're going to communicate, verbalize that to you, just to ensure you have a second set of eyes on your deal from a third party that obviously we're going to be involved in it if we provide a mortgage, but having someone who on average we see around 100 deals a week, we only approve around 20% of them. I think it's invaluable to have someone looking at that volume of primarily flip deals on a day-to-day basis, assessing your deal, ensuring purchase price, ARV, renos, everything's on a conservative basis. And the scope that we like to view the deal at is, does this make sense for the client? Even though that we make money off fees and interest, we have a minimum profit threshold of 20 grand. It's extremely rare that the profit's in and around that 20 grand. It's normally around 40 to 75-ish, depending on purchase price, renos, location, all that stuff. But you have someone else assessing your financials on the flip, ensuring that it's going to appraise at, subject that you actually do the renos that you pitch and provide to us. And I just think that is so invaluable from someone doing it for over 45 years. The company's seen everything in their existence of deals going well, deals going bad. So we share all of those resources, all of those learnings for clients. So that's number one. Number two is, to your point, if a client is buy, renovating, and selling, we look at that differently than a client who's burring or buy, renovating, and refinancing. A lot of our clients are business for self. They're tradespeople, electricians, general contractors, whatever the case may be. And to be tax efficient, they show that they made 20, 30, 40 grand a year. And how we underwrite is, as long as they're flipping, as long as you have the capital for all of your operating, purchase price, closing costs, mortgage payments readily available in either cash or debt that you can show us that's liquid as of today, You can buy a property for 200 grand, 700 grand, 800 grand. As long as the numbers make sense in terms of profitability, you show us that you have the capital, there's no issues with location, property type, exit strategy, all of that. And we have confidence in your business plan in order to execute the plan. Sky's the limit for some of these clients. You're able to do, subject to due diligence, obviously, multiple deals at once. We have one guy doing 20 flips currently right now. I know there's a lot going on with promissory notes and stuff like that. We do not encourage promissory notes. All of our mortgages are registered on title, but if you want to scale up your operations, we're able to do that. And we've seen clients who started doing this part-time. Now they're doing it full-time. They have a whole tradespeople and team under them. So as long as the exit's a sale, we're not taking a look at GDS, TDS, income, the typical underwriting criteria and debt service ratios. Or sorry, I guess I already mentioned that. But so yeah, we don't underwrite traditionally just because we understand what the property will look like as if complete. You show us that you have the capital to service everything and the numbers make sense. However, if the exit is a refi, then we will take a look at that, the other underwriting criteria, just because the takeout lender, they're going to be focusing on that as well.
Yeah.
Too.
So I think the first thing you said there, I got an example of how you used your experience. So originally this guy came to me and he wanted to do something with he wanted to renovate the basement and he wanted to convert the ADU. He wanted to convert a garage into an ADU. And we originally did the numbers based on doing all that work. But Calvert came back and actually was like, we don't like the permit. The permit part of that for that ADU is where we feel like you could run into some trouble in terms of length. So they didn't reject it. They said, what is your strategy for permits? Or do you have a strategy for permits? And then when we went back and looked at it, we had a discussion with the client and he decided, okay, let's just do the one unit in the basement, adding a unit in the basement, converting the unit upstairs, and leave the ADU for later. And so he was like, it still makes sense if we just go in there, do this renovation, and later on, I can come back and I can do the ADU. He was happy with that. We were able to move forward. But it is true. When I did ask him about the permit strategy, he's like, oh, I know somebody. And I was like, nobody wants to hear that we're relying on because you know somebody in the municipality to get the deal done. So I was like, that's not going to be a permit strategy, at least like officially. So it's funny that was the response. But that was one of the ways where you raised your hand and said, listen, we know that permitting can be an issue here. And you're trying to do this project in 3 or 6 months. And we've seen permit be an issue that could push it a lot further. So that would be your expertise helping in a situation.
Yeah, and to your point, like we don't want to be a hindrance to the deal. We're doing everything within our power as long as it makes sense to get the deal across the finish line. But we've just seen so many projects where they forecast it'll take 4 months, 6, 8 months, 9 months go by, and the biggest challenges that we see are permits. And then if they're getting properties with tenants, they're not getting vacant on possession, that can be a huge hindrance. And last year we did around just over 800 mortgages. So we're not trying to persuade or push back. We really want to see you be successful. From what we see on a daily basis, these are one of the two most common reasons of we see deals taking extremely long from the original plan that you have set in place, and it's because it's not within your area of control that you can, or your area of influence that you can really control. It's only to some extent. So we're still trying to push everything through the finish line, but we really want to see clients successful. And those two issues commonly come up of why deals always typically double over the projected timeline.
I guess one other thing I wanted to hit on is as you use and keep using, or as you, I guess, get experience flipping in general, being able to prove that, and also with Calvert, is that help the underwriting process? Does it obviously gets easier because we're going to be better at giving the deal and giving it the way you like it. But is there any kind of, if there's a close spot or something like that, is there anything given if I've done 5 deals or if this is my first deal or if I've done 20 deals with you, do you consider that in your underwriting kind of process?
100%, definitely. We have quite a few clients where now we're at the point where they have a purchase agreement, they have the renovation plan, they just show us our proof of funds. It takes them an hour or so to put together, and it's primarily the renovation plan, and they just submit that to us. We are very relationship based, so once that track record's there, that relationship is there, the timeline in order to fund deals is that much quicker just because we do have a relationship. They have a track record. We understand the renovations that they do. We track all of the properties that we lend on as well too. And we essentially have a benchmark of what the property sells for and what our analysts valued it at. We're typically within around 2% of what the property actually sells for versus what our appraiser valued it at. Keep in mind, obviously, there's been a lot going on in the market depending on the property type, community, and the location. So there's obviously some outliers, but yes, if a client has a track record, we're more than happy to do what's best in order to optimize and have an effortless experience on their end. But even if they aren't doing volume, like if we have a client, they do one deal, the property sells, it's complete, and they're looking to submit another one, as long as it's a year or less, we don't need updated documentation every time. So once we have app, credit, NOA, proof of funds, their renovation agreement and their renovation plan on the first deal, the next deal, as long as a year hasn't passed, we can use all the exact same documentation, and all we need is the the renovation summary and proof of funds. So it's quite seamless, we'd like to think, for just not having to update documentation every time, because it is obviously a pain having to fill out an app, pull credit, notice of assessments, all that stuff. From a client's point of view, I've done it, and it's a hassle. Like to think we're trying to reduce documentation while managing risk on our end and creating a win for everyone, where not a bunch of documentation, but you give us all the information that we're looking for.
I love it. So that's the second thing I've learned in this call. So I'm writing down my nuggets. Because honestly, I have certain clients who they're going to use Cover to build their portfolio quicker than they can do it themselves. So it leads me into, let me make sure I get my note here for that. Don't need to resubmit, because that's a selling point. Because yeah, you're right. Some clients, they absolutely hate providing documents. And if they say they don't need to do it, so we're going to get into why use a private lender. And honestly, for some clients, that might be, oh, I don't have to keep giving them documents, because they hate it, especially now in the past, even 3 years or even a year, of how much more documents we got to give typical A lenders. Don't need to update documents. So I guess let's get into why use a private lender. For me, I'll start it off saying I have clients who their TDS, and there is usually the issue, the TDS, they're out of whack. And there's a lot of things we can do as a mortgage broker that to get you like even all the way to 60-60 ratios, or even 70. There's a lot of cool programs, right? I have 70 lenders, 40, but still there's a time to use private lending, and there's a time to use it for, what was the question? Why use it? It's when you're trying to get in and out. And sometimes I could have got a B deal with the one that I did. I was like, you could go B or you could go private. He chose private. And why did he do that? I was like, well, B's still going to come with fees. They're going to hit you with the penalty. And I was like, so if you do the calculation between private and B, I personally think you make out better with private, because it's all about how quick can you do the renovation, how quick can you refi, how quick can you get out. If you go B, you're going to get hit with a penalty, and that has to be taken into the account. And we did the numbers, and it made sense to go private. But what are other reasons why you find all your clients 800 deals? Why are they going private? Besides, it's easier. What are other reasons that stand out to you?
Yeah, the first one that we didn't touch on is definitely quick closings. A lot of our business is similar to your deal. It closes in under a week, or it closes in 2 weeks. A lender, B lender just can't close in time. So we're able to offer a really quick closing, and that's a huge value add to clients, especially if they're active real estate investors. They're working with a seller. Maybe the seller's in a distressed situation. Because we can underwrite deals typically in 24 business hours, if you submit us a deal, and it's for Joe Smith, and he's working with the seller, and the seller wants to sell next week, a huge value add to some of these real estate investors is having a really quick closing for the seller, because they need to offload the property as quickly as possible. So number one, definitely quick closing. Number two is similar to your point, is we're not taking a look too much at GDS, TDS. So clients are definitely able to scale up, subject to due diligence, but stretch their capital further. And as opposed to doing one deal with 20-25% down, they're able to scale up if they want to have a lower down payment option. So they can obviously get the benefit that real estate offers in terms of leverage, and stretch that even further, specifically when it comes to us. And then to your point, reduce documentation, no appraisal, don't have to worry about the headache. They have confidence knowing that if we approve the deal, we're actually going to fund it just due to our history. and relationship with our clients. And then the fourth point, probably one of the more important ones, is actually a product fit. So the reason why we're in business is because the big banks, B lenders, they hate the short-term lending. They think it's too risky. They don't understand it, especially when it comes to flipping. So we really carved out a niche. And as opposed to going to a B lender or an A, it's just not a good product fit. Clients want something fully open, quick closing, a lender that really works with investors and helps create solutions as opposed to creating roadblocks to help them scale their portfolio. So it's just really having a product that aligns with the clients trying to achieve. And we'd like to feel that we've really tailored our products around really good customer service, a really unique value proposition to create something that's in demand, something that people want to use. And to your point, it's cheaper and in that scenario as opposed to going to a B lender. And it's just breaking down all the costs associated with your legal fees, appraisal, prepayment penalties, obviously rates and fees, and just doing a side-by-side comparison. And when it does come to our rates, fees, and total value proposition, it makes a lot of sense in most instances, depending on the client scenario, to actually go private because it gives them the access to the capital that they need. And it's a really good product fit.
Yeah. So basically when somebody asks you why to go private, like everything you just said is the opposite of what A lenders do. A lenders are slower.
Yeah.
We want to be
Exactly.
broke. Like one,
Yeah.
It takes us a whole week just to get a commitment. Two, then we have to meet all these conditions. Three, we have to be close. Like those conditions, I always tell clients, within 2 weeks before it funds, they want to have a broker complete. It just the documentation, the time it takes, everything you just said is the opposite of A lending and how they think. They think guidelines. They're checking boxes. If it's not in the box, it's even though it makes total damn sense, they're not thinking about the sense. They're just thinking about, is it in this box? If it's not, then it can be an issue. So yeah, everything you just said like is the opposite of how A lenders think. B, there's more flexibility, but still A lender, it's like everything you just said is the opposite. So it's really cool. And then so I think one thing I wanted to touch on for that flip analyzer is we will in this show, I'm going to put in a link and I'll put a link like you can send me a direct message or I'll put it in the link of the show for the flip analyzer. I always try to get even when I'm coaching now, so coaching or even I'm an investor focused mortgage agent. So when I know people, they might not even be thinking about private, they might not be even thinking about it. I motivate people because I tell them, look at this product. This is a sheet. I want you to think about your deals that you're going through with this sheet. And it's good, even if you're not using whatever, you still think about it like this because you can tell that sheet is set up for an investor to think and put it on paper and come up with a good plan. So I share that sheet a lot. I go through and coach people on how to fill it out. And the big value add, I think, where I'm in this equation is one, I'm going to make sure that you're thinking about it, that sheet. And two, it's making sure you have an exit plan. And that's the most important thing, I think, or at least I've noticed, and getting these deals from Calvert is if they're only funding 20% of if you did 800, but I'm trying to do the math, but if you're funding 20%, I think that my percentage is going to be higher than 20% because I know what they're thinking. I know how they're thinking. And the big part is the exit plan. And that's my specialist is making sure there's an exit plan. And even one thing that I've talked to Calvert this week about was part of the exit plan. People don't know, like when they go to a mortgage broker, I can figure things out that other people can't because I have a residential mortgage department. I have a commercial mortgage department. I know that you can get a commercial loan even on a residential property. Most people don't even consider that in their thinking. So yeah, we consider A, B private, but also there's commercial loans on residential properties. That could be an exit. And the big difference, and you can correct or I guess supplement, but when you're dealing with a residential mortgage, the lenders are betting on your ability to pay back. When you're dealing with the commercial, they're betting on the property's ability to pay back. So if you're getting a single family house and turning it into a legal 3 units, a commercial lender would jump all over that if we can't make it work because of your TDS or whatever it is. So that to me is an exit that not many other mortgage brokers are even going to consider. I'll pause there because I know I've said a lot and I want you to think about it from the Calvert lens, but go ahead. Sorry, Ryan.
Yeah, no, you mentioned some fantastic points, absolutely fantastic points. And a few other things that I would mention is when you're coming to a broker and you have a deal, you are essentially, when it comes to this specific product, you're pitching a business plan. You're saying, hey, I'm buying this property for 500 grand. I'm going to put 50,000 into it. I think I can sell it for 625. This is the due diligence I've done. I have 5 different contractors. They walk through the property. They quoted me the exact same scope for the renovation. These are the funds that I have. I think it'll take 6 months to be conservative. I'm going to project 8 months. These are the numbers that I have laid out. And when clients do that and they submit it through a broker, it's music to our ears because we get stuff that's piecemealed. Oh, I think I can sell it for 600. I haven't really dug into the comps. I'm working with a buddy. He's a contractor. He put together this rough quote. I think it's accurate, but I'm just really leaning on his expertise because I trust him. He hasn't confirmed that he can start work right after closing date. He has quite a few projects on the go. Stuff like that creates, I don't want to say anxiety, but when you come prepared, you have a plan, you pitch it to us, your likelihood and just the way that you come off in the eyes of a lender is tenfold compared to someone who's just praying and wishing and really relying on the mortgage broker to do the underwriting, ask them for the due diligence. So that's definitely point number one. I didn't know that you could even get a commercial mortgage on a residential. That's something really interesting that, even after this or whatever the case may be, I'd love to pick your brain because that is something that would be so beneficial when it comes to clients refinancing. And having the ongoing education, to your point, is crucial and paramount because whenever we get a deal, the first thing we're going to ask you is what the address is. We want to make sure that it abides by our location requirements. What property type is it? How much you're looking to put down? Exit strategies, usually question number 4. Question number 2 is how are you going to pay us out? Is it going to be a sale? Is it going to be a refi? Okay, has your broker pre-approved you for the refi? Have they approved you up to the amount that you're looking to exit at? Your GDS, TDS, income credit, like what lender are you going to, what mortgage product? And when you're able to speak the terms of the lender, it just really sets you up for success in the lender's eyes. And when it obviously comes to the private space, it does come down to obviously relationships, due diligence as well too, but having that view of the lender in order to make their life easier is obviously something completely rare, but having the view of the lender is obviously an important skill to have, especially if you're a real estate investor, in understanding what they're taking a look at and how they assess risk in order to grow your portfolio, because it's going to be paramount on getting educated on how you can scale your portfolio, working with great brokers like yourself in order to just, set yourself up for success.
Yeah, I agree. I think it's for my coaching, I take it as a requirement. As one of my first steps is you need to think like a lender, because a lender is thinking like that for a reason. Mm-hmm. They have experienced lending money and they're doing that due diligence. They're looking at things. Everything they look at, you should get good at. Plain and simple. It's not just because you got to get good at it for submitting it to them. You should be good at it because they're looking at that for a reason. They're not just randomly saying, well, I want to look at these things. They are doing it for a reason, and that's what you got to get good at. That's number one. I think you say the business plan, you're basically coming to a business plan for the property. So one thing we do at LendCity that's very unique, not to keep trying to sell myself, but it's just, I think you should be doing this. And if you're a broker, then listen up. We do a real estate portfolio investment business plan with you. We'll guide you in doing that because we don't just want you to think one time. We want you to think longevity. And so when you're not just thinking, oh, I'm going to close this first deal with Covered and then I'm going to do this. No, we want to plan it out. Tell me what you're trying to achieve long-term. Let's plan it out and let's actually put a business plan in place. And I'm going to be calling you. If you told me you want to buy 5 properties and we put a business plan in place, I'm going to be calling you saying, hey, what's happening with this business plan? Do we need to adjust it? Do we need to update it? What has changed? Things can always change, but at least you have something on paper that you're working towards and you're being less reactive, more proactive, and hopefully that's going to help you build and grow faster. So I think that's one thing is the business plan you just mentioned. I think that's really important, not just for the actual property purchase, but for your portfolio as you try to grow. And another thing is, I think that we're really unique in is we give a pre-approval. When you close, we give a pre-approval. Like my present to you is a pre-approval for your next purchase. I'm always if you're an investor, the
Ooh,
next
I
day
like
I'm giving
that.
you your present and I'm giving you a pre-approval of how much you can get for your next purchase. And if you have a real estate business portfolio plan with me, I'm giving you the pre-approval and I'm also going to refer to that business plan to talk about next steps because I always want you looking forward. And that's why a lot of realtors work with me because I'm going to generate more business for them. But to me, I have this thing, it's win. 3 levels of win at least, meaning it's a win for the client because they're building their dreams and their portfolios. It's a win for the realtors and the professionals working with them. They're going to all be on the same page. And because they know it's not just, oh, I'm going to do business one time and then I'm done with that person, but they are continuously maintaining a relationship. And then it's a win, obviously, for our business because we're doing more and more mortgages. So I'll pause because I go on my tangents, but you got me really excited with the business plan. And I just wanted to share kind of certain things that we do because that's what I'm passionate. I'm not in the mortgage business to just do mortgages at all. I want to help people grow portfolios. I grow my own portfolio. And my general kind of strategy is, and I think Calvert's kind of aligned based on the words I've heard before from Calvert, is we want to grow with you. I want to have 20 clients or 50 clients that have hundreds of properties, and we're going to keep moving and keep growing and making sure that we're growing together. I don't want to just get a sick person I'm going to get all those documents one time and then go through, oh, I don't want to give you documents. And then we complete a mortgage, but what the average person might do a mortgage 3 to 5 years and then I don't hear from you again. If you're an investor, I want to work with you to grow. If you want to become an investor, I'm going to grow with you. If you're a one-off, sure, but I still try to convert those people to investors because I believe in real estate investing myself. I think it's the common person should be doing it, in my opinion.
Yeah, and that's a key takeaway for me is I have never heard of a broker giving you a pre-approval next day once you close. I think that is such a huge value add. That is, wow, that would blow me away as a client for sure. That is absolutely remarkable.
Think about it. We already have the documents. The documents are all updated. It's kind of like you not having to give documents within a year, which I have a note here. The notes I wrote is that one. Ooh. But it's the same thing. I already have updated everything and I know exactly what the new expenses are. Boom, shoot that in and tell you, as long as you have that down payment, here's where you are. And then I even break it down to different things. Because we have certain lenders that will go, the typical lender wants their GDS and TDS 3944, but then certain lenders will allow you to go to 50/50, A lenders, and certain lenders will look at the subject property rent and all those types of things. I actually have that in the pre-approval. I'll give them like different scenarios because like you use that example of the million and the 750. It's all based on scenarios. I never want to give somebody a pre-approval and say, oh, this is your number. I always say, this is your number, and here's the different factors we put into your number. You always have to make assumptions, right? Like your assumption of how much is the tax going to be. Your different assumptions need to be clear. So I never give somebody a number of your proof. You can go for $1 million. You can go for $1 million if the taxes are this, if there's no boiler, whatever it is, I want to educate the people I'm working with so they know the different factors that will impact their mortgage. So then it's good for me, it's good for them, right? I teach them once, they know it forever, and it will cause them to make less kind of mistakes as they grow.
That's awesome. That's awesome. That is such a good best practice and really sets the client up for success, and having the understanding of what's possible right when they close opens up so many doors and great value proposition on your end.
Even I think from Calvert, do you guys have any, because I know you guys have so many deals. So I give them advice on what types of renovations are going to add the most add value. Do you have any kind of literature or anything like that that you share or that you publish?
Yeah, typically I'll reference it in the footnotes here, but there's the Appraisal Institute of Canada released an article. I forget how old it is. One of our in-house analysts provided it, and it's the renovations that increase the value the most. Typically, number one is painting. Renovations within the bathroom, within the kitchen, typically have the most value add. But I'll provide that list. I forget it off the top of my head specifically how they had it broken down. This was like 7 months ago, but those three typically right there from what we see on it. Paint is obviously huge. It's one of the most obviously largest return on investments as well too for the work involved. But yeah, more than happy to share that list in order to help clients just stay up to date on the literature. A few other things that I would note is, are you familiar? We released a few new products as of late. Have you heard of the interim purchase one? It's essentially, we just started doing this, I want to say it was about a year-ish or so ago. And it's the exact same for the most part as the flip product, except no renovations are going to be involved. So we're lending on the as-is value. And there's two most common user case scenarios that we're seeing with this product. Number one is A lender, B lender can't close in time. So if you have a client, they were set up for funding on Tuesday of next week, and A lender pulled out for whatever reason, this would be a product for clients that are in those unfortunate scenarios. And user case example number two is pre-construction. So value number one is we lend on the as-is value. So if the client bought 2 years ago for 500 grand, it's worth 600 today. We would lend on the $600,000 as-is value. Benefit to the client there is they're getting it with lower amount out of their own pocket. On the flip side of this, if it's unfortunately gone down because we lend on the as-is value, then we need a little bit more down. But going back to the example number one, bought for 500, it's worth 6. We can close in just a few days. It's fully open. We don't need an appraisal. So if the client bought 2 years ago when rates were significantly lower than they are today, and now they don't qualify, and the builder let them know that, hey, yeah, we're ready to close in 2 weeks, a month, whatever the case may be, this project allows the clients to close, and they just list it on the MLS to offload it if the numbers don't make sense, if they were originally looking to keep it as a cash flowing rental property. So we essentially help clients just close, they list and exit, and it's a win for everyone if they're just looking to close and exit on the property.
Nice. Okay. Yeah, send me some literature on that. That sounds pretty interesting. I can have some cases in my head where that could be used.
Yeah, so just a short-term solution with a quick closing where no renovations are going to be completed, and it helps the clients close. And if they're looking to exit, obviously work with yourself to ensure that they're going to qualify on the exit. But if they're just looking to offload and they're only going to keep it for a few months, they're literally able to close, list it on the MLS the next day. If they're in and out in 14 days, they're charged 14 days interest. If it's 45, they're charged 45. However long the capital is out for, then that's how many days that they're charged.
Yeah, that's really cool. I think some listeners might have a question about that. So you have a deal, you got it through, it's approved, you got the money, it's a six month open. What happens if I only need 2 months? And I think we touched on it, but it's still, I want to emphasize how the interest works, the per day. So say I only had it for 14 days and it was supposed to be 6 months.
So because it's fully open, there's no prepayment penalty, any of that. You're charged daily. So how you calculate the interest rate is the interest rate. So say if it's 10%, you times that by the mortgage amount and divide by 365 to get the daily interest rate. And then you just multiply by however many days you expect to be in the loan for. And it's really handy because it's in the Flip Analyzer tool as well too. So you're able to see how much your interest is on a daily basis in order to obviously incentivize yourself to shave off and be in and out. Yeah, if you're paying an extra 100, 150, 200 bucks a day in interest, depending on what the mortgage is and the interest rate, shaving off a few extra days, making a few $100. I know it motivates most people.
It's so motivating. The guy that closed today, I told him, I was like, if I was you, I would have waited till Monday. I would have got permission to put all my supplies in the driveway on the weekend. And I would have had I like putting a storage box there and everything. I don't want the trades to say, I need to go to the store. My goal is no stores. You're working, when you're here to work, you're here to work. And so that's what I would have done. And that's because I would be motivated because I seen the flip, I seen the day. I was like, hey, that could be the difference of $800. It's $800, $800, but
exactly.
I like it in my pocket. So yeah, it is motivating knowing that if you finish early, you can avoid all this cost. Obviously, I still did tell him, like, listen, you still got to do quality work. Don't just rush so much.
Yeah, exactly.
There's a fine line. But it's a cool thing that they show.
100%.
And then
break it.
Pardon?
And then the other one is we're starting to do a little bit of multifamily as well too. Minimum that we need down is 10%. Low money down for multifamily. We go up to 65% loan to value of the after repair value. 6 month term, fully open, renew for another 6 months as long as the client's in good standing. And most common user case scenario we're seeing for this is a repositioning product for CMHC MLI Select program. Most will lend on a one property, which unfortunately limits a few individuals is 1.5 million. So if it's in Windsor, Sudbury, Sault Ste. Marie, where purchase prices are obviously typically significantly lower than in around the GTA or southwestern Ontario, is what we're doing. So just started doing that a little while ago. We've had some success with it. We do quite a bit of it up in Edmonton, where your money typically goes quite further as opposed to Calgary. So that's an option as well too. With those, we do need an appraisal if it's 5 units and over 1.5 million. So with that, we would require appraisal, but anything 4 units and below and 1.5 million and below, we can use our in-house
And what's
analysts.
the minimum down payment on that? Is it the 35% or did I miss that?
10%.
Okay.
Minimum down is 10%.
Yeah, if you could send the literature on those two products, those are something I'd want to add to my wheelhouse for when I'm doing my coaching. It's something they should consider.
And then a few other things to mention, just in terms of deals. We've been seeing quite a bit of debt consolidation. Unfortunately, it's just not in our focus. Refinances aren't in our focus. Mixed use, high loan to value stuff in second position. With unfortunate how the economy is and people being leveraged, we're starting to see quite a bit of it. So just don't do clients in those types of scenarios. Just to save everyone time.
Yeah, no, for sure. It's really important. That's important. So I think I want to say one thing that you said about adding value. I had a little note on that is it's really similar my approach to your approach on the adding value of where to do the renovations. Always kitchens, bathrooms, paint is obviously huge, and flooring is, to me, those are the 4 common. And then I wanted to add the little spice of anytime you can add a bedroom and not take away from the property, it's never a bad thing. And I think you're always adding a lot of value when you can add a bedroom. That's just my general advice I usually give my clients when I'm coaching. But I will take that document you said. Yeah, that's the cool document to have. And a part of when I say business plan, these are things that you want to have readily available to you in an organized way. So even the 3 products that you've met, the flip analyzer, to me, that should be something you use, even if you're not doing a Calvert loan or not. Like, that's something you should always have. And then knowing about these other products, because a lot of times people not knowing that things exist, like you didn't know about the commercial exit, that means like there's a lot of deals where they can't exit. You can send them to me. I'll take them and I'll figure out how to exit because I know that I have that knowledge, right? Knowledge is power. And who you work with and who that power team is, obviously, if you're doing these types of things, you want to have that contractor's key and build that relationship. But the mortgage broker, you would never think about it as being like a huge key like I'm proposing. But when you have somebody who is an investor-focused mortgage broker, investor-focused professionals in general, it's something I really preach and I encourage to listeners to get that power team. And I'm not just saying me, I'm just saying in general, make sure you have investor-focused resources around you, because it can be the difference of your portfolio growing in a flat curve or that upward cycle, right? Like, my goal is to get you really hammering it. And I truly think that I can add value by knowing about all these products from privates and just knowing about all the different ways that we can help you grow. And I care about that more than, you don't have TDS the same, or you don't have all these documents. No, that's not ever how I think. A lot of people don't even come to the table or come to the ballpark to play because they think they don't have the tools. They think, my taxes are bad. They've been talking to their banks about they don't put anything on paper. There's products out here that if you are good at what you do in terms of finding value, being able to execute, and you have an exit strategy, there's nothing holding you back. So that's my last. I am going to leave it to you, Ryan. Anything else do you want to touch on before we start to close?
I think you nailed everything on the head. Yeah, I love what you guys are doing, creating education, helping real estate investors. And to your point, having someone who's also investing in the asset class is a huge value add, just because you know it, you live it, you breathe it, you understand it, you're experiencing it firsthand. So that is something that we always recommend clients is work with a realtor, work with a mortgage broker who's investing in the same asset class that you're looking to get in, just because having that lens of the firsthand experience as well as coaching others.
Sorry, you froze for a second. So I heard as well as coaching others, and then your audio cut out. Here, I turned off my video. Ryan, can you hear me? Okay, yeah, I'm going to turn off the video and let it just. So yeah, you said the importance of working with professionals in your same asset class, and then it cut out. Can you repeat that? I appreciate that. I definitely would be the one. I love to always continuously improve. Just in general, that's the engineer in me. But I honestly, you guys, this isn't just because you're on the show, but you provide a good service. You're really responsive. You'll say, "Oh, if it's going to take you 2 days, you're going to say it's going to take you 2 days." So then you're setting an expectation with us. You're very fast, and you'll tell us why if it's going to take whatever. So that's what I really like. You're really open book. I've enjoyed working with Calvert, and I think Ryan, maybe we can talk after this about. So we have something called the LendCity Investor Hub, where basically we have a investor community. We've created this about 100 and 120 days ago. We have 600 investors that are in this hub, and we actually have live. We do the same thing we basically just did, but we just do it live with investors that actually can ask questions as we talk. So they can do it meeting raising their hand, or they can do it via a chat. It's usually a Teams meeting. But we have about 70 or so people in these calls. And that's something that when you talk about working with education is a huge pillar for us. And I think that there's some value possibly in us doing a webinar on that show where you'll get live questions from the audience. And a lot of these people that I coach are actually in this hub already. So it's nice that they're going to hear it from your mouth and not just mine. But yeah, that's something we should consider. And if any listeners there, you can send me a DM. Instagram, Turnkey McCallie is my handle. That's the easiest way to get in touch with me. Ryan, how do you want to leave how to get in touch with you? Even though I would still advise you that coming to me, then me going to Ryan is the best way, because I'm going to make sure that you're presented kind of the right way. Okay, cool. I appreciate you taking the time this afternoon, Ryan, and happy Friday. I hope you have a good day, good weekend. And yeah, thanks for your time. And we'll chat more about some other things we can do in the future. All right, you too. Cheers.
If you're serious about real estate investing and you want to take it to the next level with the least amount of time and mistakes, then you're going to want to sign up for our Real Estate Investor Hub. Visit CanadianRealEstateNetwork.com and hit the blue button or banner that says Free Investor Resources. Inside, you'll have access to real estate investing courses, networking opportunities, webinars featuring industry professionals, as well as dedicated chat channels to share and get access to unique properties. I look forward to seeing you there.